Hello everyone, welcome to our weekly or bi-weekly webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. Hopefully you can all hear me. If you can, then please do just drop me a quick note. I will be keeping an eye on the questions tab. If any of you do have any questions, thank you very much. I believe the sound is working perfect. If you can all just check out the what's on screen right now, and we will then quickly move on to the analysis of both the charts, but also take a look at the upcoming week in the markets and highlight some key events. I'll leave this up there, the disclaimer, for you for the next 10 seconds or so, and then we can quickly move on. Thank you very much, Alex, for your reply. Perfect. Thank you all again, once again, for joining us. For those of you who checked out the video at the weekend, then you may notice that there is a little bit of repetition. We are going to cover the week ahead, but the most important thing about these webinars is that you get the opportunity to ask any questions. So please do not be shy. If you've got any questions, please do just ask them, and I'll try and come to as many as I can at the end. In terms of the week ahead, I think there's a couple of things that we need to note. One, from the US perspective, it's going to be relatively quiet. You'll see on the economic calendar here, this can be found, I should say, on the OANDA Market Pulse website. That's marketpulse.com. It's here that you'll find you'll get access to all of the content which myself and my colleagues produce throughout the day. You can see that Kenny, for example, has just produced one 39 seconds ago about dollar CAD, and then you can also get access to everything else, including a recording of this video, which can be found in the videos tab as well. But as you can see on the economic calendar, which can be found on the site, that there's some US economic data being released throughout the week, and let's be honest, it is the US economic data which tends to, well, which can often have the greatest impact. While there is plenty of economic data coming from the US over the course of the week, it's all really tier 2 data, so there is going to be questions about just how big an impact that's going to have this week. Personally, as far as I'm concerned, there's a few things which I'm going to be keeping a very close eye on. One is going to be central bank speakers. So you can see here on Friday, we're going to hear from Janet Yellen late in the evening. We've also got things like Esther George, among other Fed policy makers. We've got ECB policy makers speaking, as you can see here, Mr. Pryor at 11:45 on Wednesday. That's GMT. I should note we're hearing a lot from central bankers at the moment. I think because there's a number of central banks moving towards a tightening cycle, I think this is one of the key reasons why we're hearing a lot more from them and why the particular speeches are popping up on the economic calendars right now. We can see again we've got another one from ECB policymaker today, whose name I'm not even going to try and pronounce to save myself embarrassing myself. And yeah, so I think this is the first key thing which I'm going to be keeping a close eye on this week. The other one is the UK. As we scroll through the economic calendar, you can see that there's a lot of UK economic data to come this week. And one of the reasons why this is so important this week is partly because it's among the only notable economic releases, but also because the Bank of England has explicitly said that it is weighing up the possibility of raising interest rates before the end of the year. And this comes against quite a soft economic backdrop, economic uncertainty following the Brexit vote last year, more of a gloomy economic outlook as well from a number of from people like the central bank and also a number of independent agencies as well. Not quite as bad, of course, as there was warnings before the actual Brexit vote last year, but enough so that the idea of raising interest rates has raised many questions with regards to the timing. But the Bank of England's view apparently is that inflation is getting a bit high. And as you can see here, you can see why they would be worried. Their target is 2%, and they're one of the few central banks in the world that are achieving way above target inflation, so they're not having the same issues that, say, the Fed is having or the ECB. But I think we've also got to remember what impact the currency implications is having on this as well. So we're expecting a slight increase. Should we see that increase, then I'd say that people are going to be far more convinced that the Bank of England is going to raise interest rates. However, should we see this actually miss and we see below 2.9% on the overall reading or below 2.7 on the core reading, then don't be surprised if we do see a slight unwinding, because clearly there's a number of policymakers on the BOE who are still yet to be convinced. Otherwise, the rate hike would have happened already. Mark Carney is clearly one among them who are more concerned about the economic outlook than they are about inflation. There's probably other factors at play here as well, which is convincing the Bank of England to consider a rate hike. Things like higher household debts, which is growing at a much faster rate than wages. I think this is a concern of the BOE as well. But I think Tuesday's inflation number is going to be the most important of the UK releases this week. But then as the week goes on, we do have more. We've got the jobs data on Wednesday. So earnings, again, is going to be another crucial component of this, as well as unemployment. Then on Thursday, we've got retail sales. And as I've said previously with the US, retail sales as a metric is extremely important for the UK because the consumer is such an important component of the UK economy. I think we've stated before, the services sector accounts for around 78% of total UK economic output, and I think retail sales or consumer spending makes up around half of this. So clearly a very, very important economic metric, especially at a time when we're talking about the consumer squeeze, about wages rising at a slower pace than inflation. Because if retail sales are keeping up, which is continuing to support the economy, then that suggests debt is rising as well. And if, as the trend would normally go, retail sales slows, then that will have a negative bearing on overall economic activity. So that's another thing to be keeping an eye on there. The third thing, which I was going to say for this week, is going to be China. We've had CPI data overnight, and we've seen that things like commodities are rising on the back of this stronger CPI reading, 1.6%. The PPI number as well at 6.9% easily exceeded expectations. So this is helping to lift commodities today. But again, we've got more economic data to come from China later on in the week. Thursday's a big day. Retail sales, industrial production, and also GDP figures as well. So certainly want to keep an eye on there. And this could have a big bearing on how we see markets open on Thursday, with the numbers here potentially being a key driver of market sentiment. Now, as always, there is always things lingering on in the background, which we'll touch on. So things like this, Donald Trump and North Korea, whether we see any escalation here. There's always the potential for a surprise on this front, which is why I think things like gold continue to be relatively well supported, because gold is obviously a natural hedge, I guess, against these events occurring. And also we've got things like Spain. So you can see here the deadline to confirm if Catalonia declared independence. As it turns out, there has been no declaration made. Once again, they seem to have opted for the "we want dialogue" approach. Now, we've had, as of yet, no response, as far as I'm aware, from Mariano Rajoy regarding this. The last time that Catalonia requested dialogue, Mariano Rajoy asked to confirm whether or not they had officially declared independence, because if they had, then he would likely go down the route of triggering Article 155, which would be effectively taking all powers back from Catalonia, and then creating bigger problems from there on in. I think that would cause greater unrest and could lead to a number of arrests as well. Again, escalating the issue rather than moving towards a resolution. But we'll see how Rajoy responds to this request today. I think what we're seeing here is a sign that many of the more moderate members of the Catalonia Parliament are potentially looking to get greater powers from Madrid, as opposed to independence. But again, it's a very complex issue, and I think dialogue is probably the best solution here, especially from a markets perspective, because what we're seeing here is the potential for escalation, and markets are responding negatively. The IBEX once again underperforming its European peers. But we'll have to wait and see how Mariano Rajoy responds to this. You have to realistically, it hasn't been handled very well so far, and I think that's a big concern for traders. Throughout the rest of the week, again, there are other things to be keeping an eye on. Things like the RBA meeting minutes comes alongside some Aussie data, which we'll be getting throughout the week. I'm not expecting too much from these minutes, just because they're very neutral stance that the RBA has taken in recent months. We've also got things like CPI data from the Euro area, again, coming ahead of the October meeting next week, when we're expecting the ECB to announce either tapering or more asset purchase reductions starting in January. The approach they take, we'll have to wait and see. There's been a lot of speculation about whether they'll opt to gradually reduce over a shorter period of time, or make bigger reductions but do it over a greater period of time. So it seems that the speculation now is that they'll reduce asset purchases from 60 billion down to 30 billion, but going through to September next year, that seems to be the favoured option. We'll hear from Bank of England Governor Carney, which of course, given all the UK data and the potential for a rate hike from the UK, will be very closely monitored as well. But like I say, politics is going to continue to be a key feature, and also central bankers speaking throughout the week. So while it may be a quieter data week, particularly from a US perspective, the rest of these should ensure that it should be anything other than dull. And also, for those of you who are interested, it also is corporate earnings season in the US. It officially kicked off last week, and that's going to ramp up this week. I think it's 56 S&P 500 companies all due to report in the third quarter this week, which again, when we've got US equity markets trading at record highs, is likely to be an important sentiment driver as well there. So these are all the key economic events which we should be aware of this week. In terms of the charts, well, looking at euro dollar here, again, a lot of what I say here is probably going to be familiar from the video which we did on Friday. Naturally, very little has changed over the course of the weekend, with the markets being closed and it being a relatively quiet morning. We've kind of stabilized here in euro dollar. We did get back towards the 50 fib here, so we did briefly get above this prior support level, which was possible resistance, and also the 55-day simple moving average. But you can see here we've run into strong resistance around the 50% Fibonacci retracement level around 118.80, and we have come lower. Now, I'm not convinced that's as far as the correction is done, and I do still think it's a correction for two reasons. One, because the pair has looked a little overstretched. This is a strong rally which we've had since the start of the year, and for those of you who have paid attention to my previous videos, personally, I think the dollar has the potential to have a positive end to the year, just because of the weakness which we've seen at the start and the underpricing that markets have for Fed rate hikes for the next 12 to 18 months. Then we look at the charts and we look at this from a technical perspective, and we have this head and shoulders here. And while we have seen a break of the neckline and a bit of a move lower, I don't think this has been completed. So this looks to me like more of a correction than a continuation of the uptrend. And we've also had the break of this long-term trend line as well. We could still see it move up towards these kind of 61.8 or even a little bit further, but broadly speaking, ultimately, I do think there is more downside to come personally here. Now, the last few days is what suggests to me we may be getting a bit more of a correction, because while we have rotated off the 50 fib, we haven't really gathered any momentum to the downside. So it seems to be a bit of a battle going on. This looks more like consolidation to me than it does a reversal. We'll wait and see how that plays out. But just personally, I wouldn't be surprised if we do see more of a correction, albeit as part of a broader correction to the downside. So I think we could see a correction to the upside as part of this recent sell-off, but ultimately I do think there's downside to come because of the corrective move of this broader uptrend which has taken place over the course of this year. As with cable, I think we're just in an establishing period. We broke through 130 a while back. This was on the prospect of a rate hike from the Bank of England. This pair, I think, is going to be key this week, of course, because of all that economic data and that speech from Mark Carney. We got as high as 136, 136.50, and at the time, I was stressing that I thought personally that this was quite overbought. I thought this is a lot of hype on the back of the potential of a 25 basis point rate hike, which was unlikely to be followed with an aggressive tightening plan. The chances are that even if we do get one rate hike, we may get one more next year, possibly, and therefore I thought 136, 136.50 was just quite overstretched. Now, we did come back off this, and we did come all the way back to 130, and again, I think we've kind of gone too far the other way now. So I think we're just in a trend or a range establishing period right now. If we're going back below 130, for me, that means that the Bank of England isn't going to raise interest rates anymore, which could still happen. Or that the dollar's strengthening quite considerably, which means that the markets are very much buying into a 3 rate hikes this next year, which they currently are not. So I think we'll probably establish a range maybe between the 134s, 132s, but we'll have to wait and see. That's just how it looks at the moment. Again, I'm not here to predict the future, just to see what the charts are telling me. And at the moment, it looks to me like there's a bit of uncertainty about where the established range is going to be. So we'll see how this plays out. But at the moment, I'm not particularly bearish or bullish on this particular pair, because I think we've gone overstretched in either direction. Euro sterling, we've come back towards these kind of 88.50s. Now I think there's a couple of things we need to note here. One, we did see a correction back to the downside here, back towards these lows around 87.50. In the longer term, I would say that I'm more bullish the euro than I am the pound. So I don't see us coming back towards, say, these kind of 84s anytime soon. Now, I was looking for a corrective, the signs of a corrective move here off the 50 back. We did see that. This was on a very volatile day, so you always have to ask questions about how much of the bounce off the 50 was technical and how much of it was coincidental. I'd say there's a bit of both personally going on here. The fact that we've come back towards this kind of 88.50 area and we're now running into support suggests to me that the market's not particularly bearish. I think the key for me here is these 87.50s. This is where we've got the 200 and 233 day simple moving average coming into play. This is also where we've got these most recent lows from the end of September. It's also a previous support zone back here as well. I think we're going to have to see a very disappointing ECB to see us breaking below these levels, because I just don't think the pound has it in it to drive this pair lower. I really wouldn't even be surprised if we continue to rotate higher relatively soon, just because I just don't see what it is that can drive the pound higher, unless we see more than one rate hike from the Bank of England. And given that I'm still not entirely convinced we're going to see one, the prospect of 2 or 3 just seems a bit too much. Like I say, if we break below these 88.50s, then it's the 87.50s, which I'm going to be keeping a close eye on. Next, if we do rotate higher off these levels, then you've got to be looking back at this resistance zone just around 90, big psychological level, previous high, 55 moving average, and then a break above there. Then we've got to be looking back towards these kind of 91s, which again is the 61.8% Fibonacci retracement of this entire move. But again, don't be surprised, as with cable, if we are just maybe establishing a bit of a range here in the near term, because I think the euro is going to go through a corrective phase, and I don't see the pound being overly strong either. Actually, staying on these charts, we'll move through to the commodity currencies. So the Aussie dollar. The Aussie dollar, we did come off these highs. We had this kind of mini double top pattern. Well, not mini, I'd say this unconventional, we could say double top, because the two peaks are not at the same levels. But to me, this still looks very similar in makeup to a double top, with the neckline coming here around 78s. We did break below here, and we are seeing a bit of a correction. Now, as always, there's two things which I look for when we see the neckline break in a double top. The first is, how does the neckline act as resistance? Well, as it turned out, it didn't act as a very strong resistance. When we break through there, then I'm keeping an eye on the fib levels, because these are possible rotation points. Like I say, I think this is good. I think that we are looking at some potential downside in the Australian dollar US dollar pair for 3 reasons really. One is the RBA is very neutral, and people were previously anticipating potentially more of a hawkish lean, which is what I think drove the Australian dollar towards these kind of 80 levels, although every time we broke above 80, it was rejected quite strongly. 2, as I've already stated, I think the end of the year could be quite positive for the US dollar. And 3, purely from a technical standpoint, if this is a double top, then that would be a bearish signal, and we're looking at possible bearish rotation points. So I'm very keen to see how we trade around the 50 and 61.8 fib and around that 80 level as well. It seems as though the 38.2 isn't really holding, because we have traded above here, even if we are trading lower on the day. The fact that it coincided with prior support made me think it could be possible resistance. But if we're looking at Friday's candle, that's a very bullish candle, and today's is not by any means a reversal. That looks like consolidation for this. So this currently still looks relatively bullish in the near term, even if in the longer term I would say I'm more bearish. Dollar CAD, we have seen a bit of an upswing so far early in the morning. I've not seen any any fundamental news that would trigger such a move, so it is possible that this is just a technical move at the moment. You can see that we did break above the 55-day simple moving average here, run into resistance around these kind of 126s and come back and find support on this moving average once again. Also a prior zone of support and possible resistance, but mainly support over the course of from the end of July until now. The next test is those previous highs, so it's 126 again, because here we're testing the previous highs, but we're also testing that 89-day simple moving average. Then you've got the previous high. I think there is room for more of a correction here, and again, in keeping with what I've been saying about the dollar. So if we do break above those 26.60s, then the next test comes around the kind of 27.75s. Ultimately, I would love to see this come back towards these kind of 29.20s, 20 to 29. 50s, even 30, just simply because then you've got this big resistance, big support zone term resistance, and then you're starting to approach the real key fib levels. And for me, that's going to be a big test of just how bullish or bearish this pair is in the longer run, because at the moment, I just don't see this as being a sufficient enough correction for dollar CAD. Sterling CAD, just to prove that this is more of a Canadian dollar move than it is a US dollar move, because we've seen a similar rally this morning in the Canadian, in the Sterling CAD pair. Now we are testing those previous kind of resistance zone once again. This was support on the way down, resistance on the way up, and then this kind of zone provided resistance once again. We've also got the 200 and 233-day simple moving average coming into play again here. Through here, anywhere between this kind of 167 zone and the 168.50s, I think is going to be key, just because you've got the 50 fib coming in above here as well. I'm struggling to be particularly bullish on this pair in the medium term, to be quite honest. The problem with these charts is when you see areas of congestion where you see multiple resistance levels, they don't all have to fall around the same level. When you see multiple resistance levels in a congested area, then it just makes it that much more difficult, as far as I'm concerned, for price to break through. And here I'm looking at the 200 and 233-day simple moving averages. I'm looking at prior support and resistance. I'm looking at the 50 fib. I'm looking at the 61.8 fib, and I'm looking at this other zone of resistance as well. To break through here, I think will take a considerable push. But also, if we do break through these levels, then I think that would be a very bullish signal because of the number of technical levels which have been taken out along the way. New Zealand dollar, US dollar, I remain bearish in the medium to longer term, but we are still seeing a correction in the short term. Like with what I said earlier, we've got this head and shoulders pattern here with the neckline around this kind of 72, the shoulders to the left here coming in towards the end of June, and on the right hand side towards the end of August. We broke through here and ran into support around just below, around 71.30. That's the 200 and 233-day simple moving average combination. From there, we did get a bit of a correction back towards, I think it was a 50 or the 61.8 fib. Let's check that out. Because, of course, the neckline, as I highlighted previously, didn't hold. So we came back towards the 61.8 fib. Again, on a very volatile day, and this was Fed day, if I'm not mistaken. So we saw a lot of volatility around the Fed announcement. So you have to factor in how much of that is coincidence and how much of it is technical. But anyway, from there, we rotated lower to make new lows. We've run into support now around this prior zone of resistance turn support, and now we're seeing a bit of a correction once again. Now, you can't expect this, if we are seeing this head and shoulders play out, and I stress if, then you can't expect it all to play out in one go, because while this is a decent size move from 73.30 down to the neckline around 72, so that's a 130 pip move to complete a conservative possible price projection, which would take us back to where we've already completed. The next move from the head to the neckline, the head is much higher than the shoulders in this case, so this is around 75.50 down to 72, so that's a 350 pip possible projection, and I stress possible. That would take us back to 68.50, so we're talking about going all the way back to these prior lows. So we are likely to see gradual retracements along the way rather than a straight line to the bottom. So I'm keeping a very close eye on these fib levels again. We're testing the 38.2 around 72. Currently, if we break above here, then 72.50 and 73 will be key for me. But like I say, while this looks a little bit bullish in the near term, in the longer term, I still remain bearish. And I think, again, this just supports my belief that the dollar is going to have a more positive end to the year, and if it does, then I see no reason why we couldn't see this move completed as per the head and shoulders. But again, as always, we're not here to predict, we're here to follow the charts, and at the moment the charts support this, and as soon as they don't, then we have to be paying close attention to that. Dollar yen, we'll finish up with the yen pairs. That's dollar yen, sterling yen, and euro yen. So dollar yen, we are in a bit of a corrective phase here. What I find interesting with the dollar yen pair, for one, in broadly speaking, we're just in a sideways trend. We've got support around 108, we've got resistance just above 114. We've broken above and below the cloud on repeated occasions. The cloud often falls in around these kind of 111 areas where we find temporary support and resistance, but ultimately we have been completing the moves. What's interesting this time is we broke below here previously, but this was broadly on risk aversion. This is when all the escalation with the US and North Korea was taking place, and we saw some big yen positions being built up, really driving the yen higher, and therefore this and other pairs lower. Since that recovered, we've seen the pair recover with it. We did break above the cloud, and we saw a lovely technical move with the lagging line breaking through the cloud to the top, finding resistance on the top of the cloud, support on the bottom of the cloud before breaking higher. But what I find interesting is we haven't built up any momentum. So all of a sudden, this isn't looking like it's going to complete the same kind of move towards these 114.50s as it has previously, and as it looked like it was clearly capable of doing. Now, whether that means that this is actually not as bullish in the medium term as one may have expected, or whether this means that we're just going to see a broader correction, we'll have to wait and see. But what I find interesting is you look at these candles every time we broke through 113. We had 1, 2, 3, 4, 5 occasions when we broke through 113, and each time this was strongly sold into on the same day before ending the day below. That suggests that there is a lot of resistance at 113. Now, again, this may just mean that we get a bit more of a correction in the near term, and as far as I'm concerned, you're looking at this chart now, and from a lagging line perspective, 111.50 really is what is a key zone of support, and a break below that over the next, say, 2 or 3 days could be a bearish signal. But the problem is, usually you look at the lagging line to confirm price. Here, if we break through 111.50, then the lagging line might actually be leading price, so that may not be the bearish signal that we're waiting for. However, should we get past the next few days and the lagging line break through here, we're only back into the cloud, we're not below it, so that wouldn't necessarily be the bearish signal, at which point I'm looking back at these 111s, because that's where price could find support from the top of that Ichimoku cloud. And at that point, I will also be looking to see whether the Fibonacci is coming into play as well, because that could be another indicator. But again, a little bit ahead of ourselves. As far as I'm concerned, dollar yen has the potential to rally into the end of the year, because as long as risk appetite remains strong, which we're not seeing any indication yet that risk appetite is softening, and as long as we do see the dollar outlook that I am anticipating, then that would be bullish for dollar yen. Added to that, you look at the dollar yen weekly chart, price broke above the cloud, as did the lagging line, so that was bullish confirmation. And now we're seeing a bit of a correction. So a correction just below 111 here wouldn't, on a weekly scale, be too much of a concern. So we are back in bullish territory, but again, we also have to take that with a pinch of salt to an extent, because we are broadly speaking in a sideways trend. Sterling yen is not quite as bullish, I guess I should say. We did have that nice rally in sterling yen. Again, that was accompanied by two things. One was improved risk appetite. The other thing was the prospect of a rate hike. But again, I think that was too strong a rally to justify what it was actually being fundamentally based on. In the near term, I actually think this looks a little bit bearish, simply because we've had a bit of a correction here, but this is consolidation. We're not necessarily, this isn't a case of we are coming back to a support zone and we've rotated strongly higher. We found support a week ago, and since then we've only had a very, very gradual increase. Now, yeah, we had this downside here last week, and that was bought into by the bulls. And now if you're looking at this purely technically, then that could be seen as a bullish signal. The only problem is, if you look back to Thursday, this was the day that we had a lot of Brexit news out, and the pound was very volatile on that day. The early Brexit news was negative for the pound, because there was talk that David Davis, the UK Brexit Minister, and Michel Barnier had effectively reached an impasse in negotiations, and that was seen as negative for the pound. So we saw a lot of selling in the pound. Later on in the session, there was talk that Michel Barnier may be prepared to offer the 2-year transition period with the UK retaining access to the single market and the customs union, and people bought the pound on the back of that. That was after the European close, and then we saw a nice rebound in the pound. So while this looks like a positive technical move, the reality is actually just that it's noise as far as the technicals are concerned. And what we're really looking at here is just a big consolidation in the pound yen, and therefore that's why I still remain relatively bearish. I'll keep an eye on this trend line. It's not a strong trend line because we've already broken below it, but it's just a key level of interest, I guess. The important level for me comes around these kind of 146s, because that's when we could be testing a break below the cloud, and that's also the 50% Fibonacci retracement of the move from the lows to the highs. So if we are going to see a bit of a bullish rebound, then this could be a key level to keep an eye on. And again, this could just be another pair where we are looking to establish a trading range between two currencies that I don't think are going to be particularly strong between now and the end of the year. Finally, euro yen. Again, it's been a fantastic year for the euro. It was one of the few currencies which held up well against the yen when we were in that risk-off phase. But now we have started to show signs of vulnerability. We reached these previous highs when we were struggling for momentum to take off, and since then we've come back towards these rising trend lines. We've broken below the trend lines. We did test back above them, but we didn't get too far before we were trading lower once again. If I'm not mistaken, we came back towards the 61.8 fib before rotating lower. And that's what we've done. Now we're testing this support zone again. Now this support zone really does, for me, stretch from through this entire previous area of resistance. So yes, we may make a slight new low, but that's not necessarily a bearish signal. I want to see us go below these kind of 130, 140s before I start to be more bearish. And even then, while you could look, depending on how you look at this, you could look at this and say, well, that's a lower high and this is a flat bottom. That could be a falling triangle, which could be a bearish signal. I want to see a third touch on that triangle before I start to come to the same conclusion, because equally this could just be a parallel channel, which is a consolidation sign, and therefore that which is bullish. This is consolidation in a bullish trend. So what we could be looking at is a move back towards these kind of 130.50s or even 130 levels, and here we will come into touch with the 55.89 moving average band. We'll also come into touch with the Ichimoku cloud. So this could be what we are looking at rather than a bearish setup, at which point we'd be looking for a break above that falling channel. So there's a couple of key things I want to be keeping a close eye on there. The first is going to be the test of this prior support and resistance, at which point these kind of 130s, 130.50s will become key, and only a break of these will make me think that we are in a correction phase of this broader uptrend. Okay, that's all we've got from the charts perspective. We've not had any questions come through, so I won't keep you any longer. Thank you very much for joining us for this webinar. I hope you found it useful, and please do join us in a couple of weeks for our next one. And in the meantime, follow all our analysis on OANDA Market Pulse on marketpulse.com. And aside from that, I'll catch you again very soon. Thank you very much.